Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, June 6th, and you're tuned into On Trend, the show designed to keep you on the right side of the trend. So today we're going to dive deep into the 200-day moving average. We're going to back test it. We're going to smooth the close to get better performance. We're going to test it on some other indexes, and I'll test the rate of change in the 200-day. All right, we're going to start off with the S&P 500 and the 200-day moving average. We'll look at the overall picture right now, and then we'll look at SPY for the shorter term picture. So if we look at the S&P 500, we can see it's moved below and back above its 200-day, and that means it's crossed this 200-day 12 times in less than 2 months. 12 months. So basically since October, we've had these 12 crosses of the 200-day. You can see we got whipsaws there in October, November, and December. We got a whipsaw in March, and I'm not sure what's going to happen here, but at the present, it looks like we moved back above, and so the cup is half full. Now, as far as my stance on the S&P 500, it's not based on the close in the 200-day. It's based on the 20-day and the 200-day, and I'm going to get into detail on why I picked that pair. In addition, I used the breadth indicators, and they turned net bullish in mid-February and have yet to turn net bearish. Sure, we got negatives out there, and I made a list of those on Tuesday, but the S&P 500, which is the 800-pound gorilla in the room, has yet to break down. Now, last week, I noted some mean reversion setups that were taking place because SPY was oversold. It was near the 200-day. The stocks in particular was oversold, and a lot of semiconductor stocks were near their 200 days and near broken resistance levels that turned into support. And, we didn't get a bounce right away, but we did get a bounce. And yeah, you can go out and blame it on the Fed, whatever. But the fact is the bounce occurred, and we cannot trade off of the news. I'm sorry, you're not going to make any money trading off of the news, frankly, and paying any attention to the news, especially when it comes to the Fed and politics in general. And I think, you can read up on IBD and other websites to learn about individual companies, to find out what they're doing, where the growth is, and things like that. But as far as broad market fundamentals, I think you're better off just paying attention to price action. Now, this brings up an interesting thing about trading an oversold bounce, because you can see here we got an oversold bounce there in May, and we got another one here it didn't appear until June, but we were oversold. I thought we would get a turn because we're at the turn of the month, but it happened a couple days later, as you can see here. But we did get the bounce. And that brings up a tough point. Do you catch the falling knife, or do you wait for it to bounce? If you'd waited for this bounce and you got in on the open here, you'd have a pretty bad entry for a short-term mean reversion trade. Breakouts are very tough to make money on unless you're in a strong trend. And if you look at the indicators down below, you can see that, RSI became oversold in late May. The percentage above the 20-day EMA became oversold with a move below 30%, and the stochastic oscillator was all oversold. And so they got that upturn on turnaround Tuesday, and so if you had acted on Wednesday, you would already missed a big part of the jump. So normally when it comes to mean reversion trading, you kind of have to stick your hand out there and hope that knife doesn't fall blade down. Now, as far as patterns at work here, I've drawn a falling flag or wedge or channel. Take your pick. It really doesn't matter. It's a corrective move after a big advance. We had this 26% advance, and then we had this correction. And, if you look at it, there's a gap down, and then there's a gap up. So we have a bit of an island reversal working here. And if you want to time, your trades to wait for that initial bounce, that gap was a nice one because you could have put a stop right there at the gap. So now we got to break above the wedge line. And there's the 50-day, which I put on there just because so many people watch the 50-day. So, yeah, we've got a wedge line breakout, and yeah, it is technically a positive here, but you've already got a pretty sizable move over the last 2 days. So I would probably wait for some sort of a pullback if I was a short-term trader here. So now let's look at performance for the 200-day moving average over the last 20 years. And this is a really good time frame to pick because you've got two bear markets in there. You don't want to test the 200-day moving average from 2009 until now because it's pretty much a bull market. Sure, there were these whipsaw type signals and breaks, but we didn't have a bear market like we did in 2001, 2002, and in 2007 and 8. Now, we can see over the last 20 years, and I'm only looking at bullish signals because bearish signals really don't work, we've had 78 bullish crosses. So you can double that for the total number of moving average crosses, basically. And of those 78, 79% produced winners if you bought on the cross, average gain of 9.1%, and 61 were losers with an average loss of 1.4%. And I've got some tables that will show you the compound annual return as well. But the main point is you can catch some good trends with the 200-day, but there are also going to be lots and lots of whipsaws. And we need to smooth it out a little bit. We need to smooth out the closing price a little bit to reduce the whipsaws and improve performance. So here's the chart over the past year. And, there we can see all those whipsaws appearing as we go above and below the 200-day and get a lot of choppy price action over the last 9 months or so. So if we just smooth out the closing price and instead use a 5-period moving average, we can reduce whipsaws and increase performance. And the way I did this was, if you scroll down on this chart, you can see I've got the price as invisible there. So I'm not showing the S&P 500. There you can see invisible. And then for overlays, I added the moving averages, 5 and 200, and green and red. And I put the S&P 500 below as an indicator for reference. So when I scroll back up on this chart, you can see here that we can focus on the crosses of the 5-day and the 200-day. And right away you can see there are half as many signals, only 31 bullish signals. We had 12 winners and 19 losers, still more losers, but the average gain of the winners was much more than the average loss of the losers. So you can see you can catch some big trends like from April 2016 or March 2016 up until October 2018, a monster trend. And you can also get some whipsaws with breakouts and a turn back down. So it's not immune to whipsaws. Now in this next window, I've got the 20-day moving average and the 200-day moving average. And you can see we have even fewer bullish signals, 15. And now the winners outnumber the losers. We have 10 winners and only 5 losers. And the average gain is around 13% and the average loss is 2.41%. And the 20-day is about 1 month. And the 200-day is just the 200-day. It's the most popular moving average out there. I guess it's around 9 months. But you can see it will reduce whipsaws. It's not immune to whipsaws. You can see I got some whipsaws there in 2015, but that is going to happen. It's all part of the game here, and the game is the stock market. And what about the granddaddy of them all, the 50-day, 200-day cross, the golden cross when the 50-day moves above the 200-day, and of course the death cross when the 50-day moves below the 200-day. And you can see it caught the bear market there in 2000, 2001. So you would have gotten out then and saved some money. You would also gotten out of the bear market in 2007, 2008 and saved a lot of headache. You would also had some whipsaws in 2010, but you would have caught a big bull run in 2013 and 14, as well as that big run from 2016 to 2018. So you avoided some whipsaws. And you can see there were 11 signals in 20 years. That's not very many signals. Of course, we've had a couple in the last 6 months or so, or 8 months. We've got 9 winners and just 2 losers. And you can see the average gain is 17% and the average loss is 3%. So let's see how these all look on a table when we stack them up and compare. All right, so don't go glazing over on me, but here is the performance over the last 20 years. And you can see that compound annual return is not that impressive for the S&P 500, but also keep in mind that this does not include dividends. So you can see when we get down to the bottom of the table, we get above 5%. So the 20-200 cross and the 50-200 cross are clearly the best out of this whole group here. You got to smooth out your close a little bit to improve performance. And you can see exposure range is around 70%, so it stays around the same. You're out of the market 30% of the time. We can see the risk-adjusted return gets to the 8% area when you got the 20-200-day cross. And look at the win percent. All right, we went from 22% win rate with just a close above and below the 200-day to a 39% using the 5-day to a 67% win rate with the 20-day and a 73% win rate using the 50-day. So that alone is one good reason to get a longer moving average out there. And my personal favorite is this 20-200-day cross. You know, it's kind of like something in between the close and the 50-day. Yes, I could use the 25-day, but it's not going to make that big of a difference. You know, please keep in mind there's no such thing as the magical combination. Moving averages are not magic. They're trend following indicators. They're going to make money if we get some trends, and they're going to whipsaw and chop around and lose money if we don't get trends. It's as simple as that. So we're counting on the market to do what it does, trend. All right, so the S&P 500 is the main index, the main benchmark for the U.S. stock market. And if I had one index to use, it would be that. The tradable instrument is SPY. It's the S&P 500 SPDR. And you can chart that with dividends. And what I'm showing here is SPY with dividends in green. And you can see over this 20-year period, it's up over 200%. Whereas the S&P 500 is up 110% over a 20-year period. And you can see here, depending on when you start, if you had looked at this period at 2013, you would have been up, you would have barely been positive. All right, you would have had basically a 13-year period here with nothing to show. And it's this gain here that is accounting for the lion's share of this 20-year performance that we're seeing. And you can see it's compounded when you add in dividends. So let's see how this test works when we use SPY with dividends. And I'll also show you what it looks like with short positions. All right, first let's look at buy and hold. If you did a buy and hold of the S&P 500 over this 20-year period, you would have 3.81% compound annual return. Total gain would be 111%. And if you did SPY with dividends, your compound annual return would be 5.76%, and the total gain would be about 207%. But the reason we use moving averages and we do timing is to reduce the drawdown. Look at those drawdowns. You would have had two basically 50% drawdowns over this 20-year period. I don't know when the next one is coming, but they do happen, and we want to avoid those. So if we scroll down, if I scroll down at least, we can see what the performance looks like with the moving averages. So in this first row, we've got the S&P 500, and we can see that we have a 5.37% compound annual return. We have a much smaller drawdown, 17.9%, and a win rate of 67%. That's the 20-200-day cross. And if we use those signals from the S&P 500 and we buy SPY, then we get more return, 6.76% per year. And you can see that the risk-adjusted return is higher there. And the maximum drawdown was about the same. And we can also see that the average gain is improved with those dividends. And if we add short positions to this mix, so when the 20-day goes below the 200-day, we short the market instead of moving to cash, you can see your compound annual return goes down. Your exposure goes up, so risk is increased. That's why the risk-adjusted return is lower, because you're constantly exposed to the market. Your maximum drawdown pretty much doubles. So you're not getting any more return, you're getting more exposure, and you're getting a bigger drawdown. And you can see your win rate is less than 50% all of a sudden. So in short positions do not add value as far as this moving average crossover system is concerned. So when the market goes, it's not because the 20-day goes below the 200-day that we're going to have a rip-roaring bear market and you can make money on the downside. It just means that it's going to be really hard to make it on the upside, I think. So people always ask me, well, what about exponential moving averages? Surely they are more sensitive to the market and you can make more money outperforming simple moving averages by using an exponential. Well, that is just not the case, at least as far as this period is concerned with the S&P 500. So here we have the simple moving averages in the top table. You can see the close, the 5-day cross, the 20-day cross, and the 50-day cross. And then below we have the same close 20-day EMA cross, the 5-day 20-day EMA cross, the 20-day 200-day EMA cross, and the 50-day 200-day EMA cross. And you can see that the returns go from around 2.76% to 5.64%. They're not that much different with the EMAs. Exposure a little higher with the EMAs, but not very much. Look at the maximum drawdowns. They're about the same. You can see this one is better. The 18% drawdown for the 200-day SMA cross is much better than the 200-day EMA cross, which was 26%. But also the win percent. All right, the win percent is 42% here with the EMAs, and it's 67%. And in general, once you start getting to the 5, 20, 50-day SMA crosses, you get a good win percent. And you look at it with the EMAs and your win percent is not improved that much. So I would stick to SMAs as far as this strategy is concerned for broad market timing. So I also went through this exercise for the S&P Midcap 400, and frankly, the results are not that impressive. You can see none of these moving average combinations produce that good of returns, averaging between 5 and 6% for the same moving average signals that I showed you for the S&P 500. And the win rate just got to 57% with the 50-200-day cross. And then if we look at the S&P Small Cap 600 here, we can see that the same thing happened. The returns are just not that good, going from 3.33% to 5%. So that's nothing special. And you can see the win rate got to 57%, but it wasn't even above 41%. So this moving average system does not work that well for mid caps or small caps, but there is a trick. Before I show you this trick, here's the Nasdaq 100, and you can see the returns do improve for the Nasdaq 100. We get up to the 10% level for the 50-200-day cross for the Nasdaq 100, which is very respectable. And the drawdown is a respectable 36%. It's still pretty high on both of these occasions, but the Nasdaq 100 is a more volatile index, but maybe there's some validity there with the moving average crossovers. So what is this little trick? Well, the trick is to use the S&P 500 for your signals and the mid cap, small cap, and possibly even Nasdaq 100 indexes or the respective ETFs for your trading. Now, the reason I'm using the indexes is because they go back to 1999, so I can have a uniform test. But the results should be similar if you're using the ETFs and might even be a little bit higher if you're including dividends. So what we've got here is we've got the S&P Mid Cap Index, and there you can see I'm using the 2200 cross for the Mid Cap Index. So when the 20-day crosses above the 200-day for S&P Mid Cap, you buy mid caps. And when it crosses below, you sell. And if you'd done that over 20 years, you had 19 signals, and you had a compound annual return of 6% and a maximum drawdown of 25%. That's not so great. And you can see you would have had 9 winners and 10 losers. So more losers than winners. That's also not that great. But what if instead we use the S&P 500 signals? So when the 20-day goes above the 200-day for the S&P 500, we buy mid caps because after all, they should have a higher beta and should outperform on the way up. And sure enough, you can see the compound annual return goes to 7.6%, and the drawdown stays roughly the same at 23.7%. But we did get the return up, and it wasn't at the expense of a higher drawdown. And you can see there were 10 winners and 5 losers. So our winning percent went up. And if you compare just a few of the signals or a few of the recent signals, and keep in mind, this is going back 20 years. All right, but here you would have gotten out if you'd used the mid cap for the 200-day cross. But here you would have stayed in because the S&P 500 did not have that cross. Here you would have gotten whipsaw because the S&P 500 had the cross, the 20-day above the 200-day, and back down. And the mid cap did not, so that one was a little bit different. Here you would have gotten a whipsaw with mid caps, but you did not get a signal with the S&P 500. And you can see here that we got a signal with the S&P 500, and we haven't gotten a cross back below with we got a signal with the mid cap index there at the top, but we haven't gotten a signal for the S&P 500 yet. So what about small caps? Well, here is the S&P Small Cap 600 and trading the 2200 cross when the S&P Small Cap 600 has this signal. And you can see we had 22 bullish signals over this 20-year period, and we had a 5% compound annual return and a maximum drawdown of 34%. That does not justify that return. The return is way too low. So this is not a good system here. And you can see there were 9 winners and 13 losers. So that's no good as well. But if we trade the S&P Small Cap 600 using the signals in the S&P 500, you can see, as usual, we had 15 signals because that's the number of signals in the S&P 500 over this 20-year period. Our compound annual return went up to 8% roughly, from 5% to 8%, and the maximum drawdown went down. So this makes this a more viable system. And this makes sense because small caps typically act different than large caps. They're more volatile. They're going to be prone to more whipsaws. And whereas the S&P 500 is more stable index. It's large caps. It's the benchmark for the market. And there's no reason why we can't cue off of it for signals and then get into higher beta names like small caps. And then you can see 11 winners and 4 losers. And the average gain is more than 3 times the average loss. So you can improve this system by using the S&P 500 for those signals and not the S&P Small Cap 600. And again, if you look at some comparison signals, there you had some whipsaws in 2014, and you did not in the S&P 500. You had a whipsaw there in 2017, and you did not for the S&P 500. Is it going to work every time? No. Is it going to work in the future? Well, there's no guarantee for the future, but this is what it's done in the past, and this can kind of set our expectations on the future. And what about the Nasdaq 100? Well, if we look here, we can see that if we use the 2200 cross with the Nasdaq 100 and we trade the Nasdaq 100, we had 21 bullish signals over the 20-year period. We had a compound annual return of 8.6% and a maximum drawdown of 36%. And there were 10 winners and 11 losers, so we had one more loser than winner. If we use the S&P 500 signals and traded the Nasdaq, we would have gotten our return up to 10%, but the drawdown did increase to 37.5%. So there is some extra risk associated with the Nasdaq 100, and we have to be careful with that. So it's not as good as we saw with the S&P mid cap and S&P small cap indexes. And of course, there were 15 trades, 11 winners and 4 losers, and the average gain was much bigger than the average loss. But I think in general, we can assume or surmise that the S&P 500 is our go-to index. It's got to be as far as the broader market is concerned. So in Chart Watchers this past weekend, the weekend before, I wrote that the 200-day moving average for the S&P 500 turned down. And, on the face of it, if the 200-day moving average, the average of the last 200 days close, is moving down, then that would suggest a downtrend. I mean, I have no argument with that. The big question is, will that downtrend extend, and does this have any predictive power? And you can see here on this chart that the 200-day peaked there towards the end of May and started moving lower. And the 200-day for the mid-cap index was already falling, and the 200-day for the small cap index was already falling. And the way I created this chart was I put in my symbol, and then I put invisible for the symbol price there. And so that means you don't see the symbol price. And then I added the 200-day moving average, so you only focus on the 200-day. And I'm only looking at 2 months, so we can see the direction of the 200-day clearly. And then you can see that I added mid-cap and small-cap indexes as a price, and the parameter is the symbol. And I put these as invisible as well. And then in the advanced indicator options, I put the 200-day moving averages. So I don't need much time to go through this table because, frankly, the performance is not that great. This is when the 200-day moving average turns down. I did the 5-day rate of change. So when the 5-day rate of change for the moving average turns down, and I used the S&P 500 moving average, the S&P mid-cap 400 and its moving average, the S&P small cap 600 and its moving average, and the Nasdaq 100 and its moving average. And you can see the compound annual return is not impressive for SPX, the small caps and the mid caps. It is 10% for the Nasdaq 100, but the drawdown was pretty high. So there may be some value in this indicator for the Nasdaq 100, but not for the other 3 indexes as far as I'm concerned. So basically, at the end of the day, I'm going to stick to the S&P 500 and the 20-day and the 200-day for signals. They're not going to always foreshadow a bear market if we get a cross, but if we do cross here with the 20-day moving below the 200-day, I think that would be a signal to move aside because risk would be above average for the stock market. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.